Or if you're going to think about loaning your shares, maybe you want a higher interest rate because, again, how's that going to affect your bottom line? So there's all these signs of this tightness that really began in early December. And so maybe tariffs, and on a mainstream sense, people are like gobbling that up and that's caused them to bid gold higher. But I think there's more likely we're being gaslit with that story, that there's something more substantial going on behind the scenes that is leading to this rush to get metal back into the U.S. We'll see. Maybe there's some kind of, we'll loosely call it monetization of gold that's coming by the Trump administration, whether it's gold-backed bonds or whatever.
CraigHemke from TF Metals Report believes gold could rise past $3,000, driven by ongoing macro trends. Although reaching this mark soon isn't guaranteed, gold has already rebounded by $100 from last Sunday's lows, highlighting its strong upward momentum. Notably, gold's price has risen in the US dollar and all major fiat currencies worldwide. This trend highlights a critical point. Fiat currencies rapidly lose value against gold. A rising gold price fundamentally means that fiat money buys less gold, underscoring the devaluation of paper currencies on a global scale. Several factors have contributed to gold's remarkable price surge across all major currencies. In recent weeks, one of the most discussed reasons is the expectation that the Trump administration might impose import tariffs on gold and silver. Goods imported from Mexico, Canada, and China are already subject to U.S. tariffs, and there is speculation that precious metals could be next. However, this does not necessarily mean that gold and silver will become more expensive in the U.S., as buyers can still source these metals from other regions without tariff-related costs. Adding to market speculation, Bloomberg News reported that U.S. investment bank J.P. Morgan is preparing to transport $4 billion worth of physical gold to New York to fulfill gold derivative contracts due in February. This significant metal movement suggests that market participants are preparing for potential disruptions. If the rumored tariffs were substantial enough, they could even justify the uncommon decision to transport silver by air, rather than the usual method of shipment by sea. While mainstream narratives suggest that the anticipation of tariffs pushes gold prices higher, there may be more to the story. Hemke argues that this explanation could distract from deeper structural issues within the gold market. The rush to bring metal back to the U.S. may indicate concerns about availability, delivery logistics, or broader monetary shifts. The driving forces behind gold's meteoric rise may become more apparent as these developments unfold. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
We're off to a great start, obviously, to the week. An old adage at TF Metals Report is it's not about how you begin the week that matters, it's how you end it, because you paint the weekly charts and that kind of keeps the momentum going in either direction. We've had a lot of Mondays lately that have been down. So this is different, that we're going up. And we'll see. It's going to be an interesting week. There's that old Humphrey Hawkins Act from decades ago that demands that the chairman of the Federal Reserve come up Capitol Hill every 6 months and sit before the Senate Finance Committee and the House Financial Services Committee and kind of give his biannual, semi-annual, I guess, State of the Union. And so we'll see that's tomorrow. That starts tomorrow. Most of the news is tomorrow because Powell will have his prepared remarks. They'll be released either right at 10 o'clock Eastern or shortly before. All the algos, will skim that for any hints of monetary policy changes. And then, whatever questions he gets asked will create headlines all through the day. So tomorrow's going to be volatile. Then we get the consumer price index. That's coming up on Wednesday. The producer price index on Thursday. So we're off to a great start. There are a lot of reasons to suspect that this next extension in the gold price will go up above $3,000. You recall last time we spoke, we talked about my macrocast. I thought that was definitely in play here in the first, 3 or 4 months of the year. And then we'd see, where we go from there. Sort of looks like that's where we're headed, though. I mean, again, I wouldn't say we're going to be there by next week, though we are $100 off the lows of last Sunday, the 2nd. So anything can happen. This situation started to reveal itself back in early December, and it went away at the end of the year. Some future selling dropped the price, dropped that spread down, then widened back out, got as high as $43 or something a week or two ago, and then dropped back down when the February contract went off. And then it expanded out, I think currently it's about $30 again. We've seen the lease rates in London go surging higher. Well, why is that? Well, if I'm going to loan you my metal and I'm not sure you're going to give it back to me, Elijah, I'm not going to give it to you at 1%. That sort of thing. We've seen the cost to borrow shares in the GLD skyrocket. Well, why is that? Well, if the only entities that can take metal out of the GLD are the authorized participants. That's what they call them. What are the authorized participants? The bullion banks, the ones responsible for flowing metal, physical metal at the digital derivative price. Well, if they don't have enough on hand, what do? They're going to borrow some shares, cobble them together into a basket and redeem them for metal. Well, if there's not that many shares out there, or if you're going to think about loaning your shares, maybe you want a higher interest rate because, again, how's that going to affect your bottom line? So there's all these signs of this tightness that really began in early December. And so maybe tariffs, and on a mainstream sense, people are like gobbling that up and that's caused them to bid gold higher. But I think there's more likely we're being gaslit with that story, that there's something more substantial going on behind the scenes that is leading to this rush to get metal back into the U.S. We'll see.
The surge in physical gold deliveries from derivative trades at the COMEX is another strong indicator of increasing market tension. With a daily turnover of $70 billion, COMEX ranks as the second largest gold trading hub in the world, following London's $125 billion. February is set to see 4 million ounces of gold delivered from futures contracts, a significant rise from the 2.9 million ounces delivered in January. Looking ahead to March, nearly 4.5 million ounces are scheduled for delivery, marking an exceptional increase in demand for physical settlement. This heightened demand for deliveries highlights growing pressure within the physical gold market and the broader paper gold system. Investors are increasingly showing a preference for securing physical metal rather than relying on derivative positions. CraigHemke suggests that the urgency to obtain gold may drive metal repatriation to the U.S. There is growing speculation that the Trump administration could explore gold-backed monetization, potentially through bonds. If implemented, U.S. government agencies and banks could accumulate gold in preparation. Let's get back to the interview.
When we first noticed what appeared to be a tightness developing was back in December, about a month after Trump was elected. Initially, gold just got shellacked for about 10% down from its highs, got pounded backwards a couple of times, and it kept recovering. But then after that December FOMC meeting, it's moved up almost in kind of a straight line, particularly since the first of the year. Back in the middle of December was the first time we saw the spreads widen from the spot price to the futures price, which at that point was the February contract and the March silver. And it got to like $30, $35. Now there should be some spread, but it should compress over time, for maybe $6, $8, $10 down to nothing. Well, when it was 35, it's like, what's going on here? And I remember the last time this happened, right before COVID. And there was, talk then about logistics and, planes weren't flying and all this kind of stuff. And again, the point of all this, there shouldn't be that wide of a spread. It should be easily closed by arbitrage. You got the spot price here and you got the futures price here. So if you buy the spot and you sell the futures, they come together. Well, why wasn't that being closed? It did close by the end of December. The point is then it widened again. It happened again in January. And now even here in February, it's, $30, $35 again. So why is that persisting? Why is that not being closed? To me, it's a lack of confidence, because if you're going to execute that trade, if you're going to buy at spot and sell the future, well, now you're short the future. Now, you could deliver, you can get out of that from two ways. You can deliver your bought, that you got to take delivery of what you bought at spot and then deliver it. Well, now all of a sudden there's this alleged 6 to 8 week, whatever delivery delay. Maybe you won't get it delivered in time. And if you don't, now you're just short, the futures contract. Well, that's no good either. So it's a lack of confidence in the system that's being, the problem is. Now, we've been told, and I was buying this for a while, it was all about tariffs, but I've not seen where gold or silver are even in discussion. We got aluminum and steel, and stuff, and general tariffs that are discussed against EU and Canada, Mexico, and the like. But I've not seen anything specific for gold. And I started thinking a couple of weeks ago, I was in the middle of a podcast I recorded for my site with Andrew McGuire. I was like, Andy, I think we're being gaslit. I think we're being told that it's a tariffs as cover. And what got me thinking about that is, Elijah, World Gold Council just last week announced another, 1,045 metric tons or something of net central bank demand in 2024. Third year in a row, over 1,000 metric tons of net demand. It's like 3,300 metric tons that, most of that I think is being taken and, moved from west to east. We know about the silver supply deficit that's now 700 million ounces at least over the last couple of years. And it just made me wonder, London operates on a pretty tight float. I wonder if maybe they're just running out of metal. And I think that's a possibility. Then lastly, I'll just add one more thing. Again, this all began after Trump. It really started kicking in December after that first pullback. Maybe, and we got some hints of this over the weekend, maybe there's some kind of, we'll loosely call it monetization of gold that's coming by the Trump administration, whether it's gold-backed bonds or whatever, that is demanding, that is forcing U.S. government, Fed agents, bullion banks, which are the primary dealers of the Treasury market. Maybe they're the one. That's why this metal's coming back to the U.S.
The rapid acceleration of physical gold deliveries and shifting market dynamics suggest that more profound structural changes may occur. Whether driven by policy shifts, rising demand for metal-backed assets, or concerns over supply constraints, the implications for global finance are profound. As governments, institutions, and investors adjust their strategies, the role of gold in the monetary system could be redefined. Could this growing preference for physical gold signal the early stages of a significant transformation in how wealth is stored and valued? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.